Hello, everyone. It's with great pleasure that I would like to welcome you all to the fourth David Backus Memorial Lecture in honor of NYU Stern's much loved and deeply missed colleague, Dave Backus. This lecture has been endowed by generous gifts from Dave's family, friends, students, and the broader community of Stern alumni. And it's our way of honoring Dave's memory in a way that reflects his values by engaging in a thoughtful academic discussion led by a true thought leader. It gives us a chance to celebrate his scholastic achievements and his leadership, which has touched the lives of many, both at NYU and beyond. So today, just a quick word about logistics. In a moment, I'm going to hand over to Laura Wellcamp at Columbia Business School, who is going to introduce our speaker for the day, and John Taylor. And then once she finishes her introduction, John is going to present for about an hour. Just a quick word on logistics. During John's talk, I would encourage all of you to type in questions and comments through the Q&A feature. Once John is done talking, which is going to be about 2 o'clock, we will present some of those questions to, Laura will present some of those questions to John for discussion, but there will also be a live Q&A feature at the end of that, during that time. So during that time, you will be able to raise your hands and ask John questions live as well. But I would encourage all of you to use the Q&A feature throughout John's talk. And stick around, but also certainly stick around for the Q&A at the end. So with that, I'm going to hand over to Laura Wellcamp, who's going to introduce our speaker for today.
Great, thank you, Venki. Welcome. I'm absolutely honored to be a part of, first of all, remembering Dave Backus, someone who was so important and so inspirational to many of us and in our lives and in our careers. And I'm honored to be here to introduce John Taylor. Many of you know John is the Raymond Professor of Economics at Stanford University, the Schultz Senior Fellow at the Hoover Institution. He's, and we know him as this incredibly accomplished person, right? He's been Undersecretary of the Treasury. He's won many prizes. He's got 200 plus academic articles. He's been named one of the 50 most influential people by Bloomberg's Markets magazine. But that's really not entirely why we have John here today, right? This is a lecture about remembering Dave Backus and his spirit. And Dave's spirit was certainly about academic discovery and inquiry and accomplishment, but it was more than that as well. So why invite John Taylor? Why do we have John here today to speak to us in memory of Dave? Well, there are obvious similarities, right? They're both economists. They both have studied macroeconomics and finance and international economics and worked at the nexus of those topics. They've both made fundamental contributions to the study of topics like interest rates and bonds and the international exchange, that formed really a generation of scholars and how they thought about international economics. And, both of them had this idea that we should bring together these fields that had been pretty disparate and integrate them and fuse them. And today's scholars get enormous insights from that nexus of finance, macro, and international economics. So those are kind of the more obvious similarities between Professor John Taylor and our beloved Dave Backus. But less obvious, they're both mentors, right? Dave naturally mentored everybody around him. You ran into Dave and you learned something useful. He taught us through his example. He taught us through formal education, right? The many students he had in class or was maybe formally assigned to mentor, but he also taught us through helpful everyday advice about how we get through this profession and how it works and how to keep yourself going when it gets discouraging and just really exuded that kind of intellectual leadership and mentorship. And similarly, John Taylor has mentored generations of graduate students. So some of them formally, he's been the advisor to many successful students that have gone on to have important influence on the actual execution of monetary policy. But for many of us, myself included, he wasn't a formal advisor. He wasn't one of the listed members of my dissertation committee, but he certainly had an influence on our time as students. He was there with questions, with suggestions. He'd show up at student seminars and offer the kind support and encouragement that makes all the difference for somebody who's trying to start out in a difficult field. So I can't wait to see what John Taylor has to teach us today. He's going to talk to us about global monetary policy rules after the pandemic. So without further ado, John, please take it away.
Thank you so much, Laura, for introducing me and remembering David so well. It's an honor for me to be here and to present and to remember all the good things about David, his clear thinking, his rigorous analysis, which is so admirable. And I'm going to talk about policy rules. He did a lot on policy rules: consistency, optimality, rules versus discretion. So those are very good things. I like how you mentioned teaching, Laura, and Dave was a good teacher. And I like to teach too. I still teach the freshman course at Stanford. I didn't know this for a long time, but I understand David is a Western Pennsylvania person, Pittsburgh, a Steeler fan, a Pirate fan. So we'll see, they'll do a little better in the future, but that's where I'm from too. It's an honor to follow Tom Sargent, Tim Keogh, and Darrell Duffy in this endeavor. So I'm going to talk about policy rules and in a broader sense of the word, a broad sense of the word. And so I'm going to have a screen come up, I hope, which is coming. Here it is. Okay, and I'll put it on presentation mode, I believe. So as Laura indicated, and thank you so much for inviting me. It's such an honor to talk about this subject in the David Backus Memorial Lecture. So I'm going to talk about policy rules, and it's not a technical talk. There's many technical things that underlie policy rules, and they have for a long time, and we all know that. But in some sense, we move through a pandemic. We think we're coming out of it. I hope we're coming out of it. And the question is, what do we do about policy rules going forward? And so that's what I want to talk about. It raises lots of questions about the pros and cons of rules, about where the Fed is and other central banks are now. And so that's what I want to do. So maybe just begin with an outline of sorts. So the overall purpose is to look for ways to return. I'll call it return to a rules-based strategy, because as I'll show in a few minutes, I think we were on, we got off, and we're still a little bit off, and the Fed and less so other central banks, but we're off. And to do this, I want to review policy changes over the last, say, 5 years or so. And I think during this period, the Fed began to move back, as it says on the slide, to a more rules-based policy. There are many papers written by people at the Fed, and many favorable comments by policymakers. I'll review that. And the Fed began to talk about policy rules in its monetary policy report. And that is the kind of thing that's so important, because it's a practical aspect of this. Now, this movement was interrupted violently by COVID-19, starting in 2020. And the Fed took actions to deal with this, health effects in particular. They were not rules-based policies. They were really special, I think, in many respects. And even the Fed stopped reporting on rules in its monetary policy report. So that was a retrogression in some sense, I think. But it didn't last too long, because earlier this year, the Fed, and I'll describe this, put policy rules back in its monetary policy report. And some of the rules they put in were different than the past, and they reflected a review that the Fed had undertaken in the last year or so. So I think that's good. But I also note, and I think this includes the meeting that occurred this week, we've not really seen the changes in actual monetary policy yet. Maybe there's more signaling. We'll talk about that in the talk. So there's kind of a gap between the rules-based policy and the actions of the Fed. And I'll talk a little bit about that. And so my overall conclusion and suggestion is very much policy related, that maybe time now for a re-entry into a policy rule, policy strategy approach. So that's the overall setup that I want to follow. And I'll use some charts and a few equations and things like that to do that. So let me just go over, I think it's important when we think about where we're going, you think where we have been recently. And policy rules, of course, were the subject of a huge amount of research in the past. And there was a lull. It was a lull during the great financial crisis. But not too long ago, say 5 years ago, 6 years ago, there was a revival. I call it a pickup of interest in policy rules. Now, some of it occurred at the Chicago, Stanford, Frankfurt, all over the place. So these are just some examples, but it gets you a sense of what was happening. So there was a very, I think, useful paper by Tom Mertens and John Williams, which was presented at Stanford. And this is in 2019. It wasn't published till 2020, but it looked at policy rules systematically. And Williams had done a lot of this in the past with a model to look at which is the best rule to follow. And in this case, there was this question of an average inflation targeting versus a specific number. We'll come back to that. So I was trying to really make the rules-based thing more up to date. And so I would take a look at that paper. It's a paper by John Cochran, Volker Whelan, and myself, which took seriously, and I'll talk about this in a minute too, the Fed's proposals for policy rules that they put in their monetary policy report and evaluated them with a bunch of different models. And so this was like a classic way to analyze policy. And we concluded, maybe not surprised to some of you here, that the rules were a good way to go. And so it was supportive of what the Fed was doing with publishing these rules. Shortly thereafter, there was an important conference at the Chicago Fed had. And this is a case where Eric Sims and Cynthia Wu, they did the same kind of thing, but with different kinds of models, and they evaluated rules, and they found them to work pretty well. Jen Eberly, Jim Scott, and Jonathan Wright did the same kind of thing using the FRB US model. And so they also saw the advantages, not perfect, that's for sure, but it was, I guess, part of this system of a revival of research. This is research on monetary policy rules. And then the same year as a conference in Frankfurt, which a number of people looked at models, and they're listed here, and the references are all available. But because I think this is very recent and is important to see what happened right before the pandemic. One thing I'll mention with a little more detail is this paper by Nicholas Gruszewski, Papel, and Podan, which has a chart here to illustrate it. This was done right before the crisis. And what they tried to do is evaluate rules without specific models. So they looked at US history, and they looked at periods where there were different kinds of rules or not rules, and they tabulated this, I think, very fascinating table, which I'll just spend a minute on. So on the horizontal axis, they have the coefficient on output in a classic rule for setting the interest rate, and you see it goes from 0.1 up to 2. And then the vertical axis, they have the coefficient on inflation, which goes from 0.1 to 2. So there's lots of rules here. And what they do with the history is they look at the periods in which rules were being followed and when they were not. And so the number there, which is very high on the upper right-hand side, represent periods when the loss from deviating the rule was quite large compared to the denominator, which is the loss when you're on the rule. And so they colored that green because it showed a big advantage of a rules. So this is not with a model, so it's an alternative approach. But what it's quite revealing is they get these very high numbers when the coefficient is on the gap is inflation gap is larger than 1 and not too large with respect to the others. That's the green area. So this was done right before the pandemic. I think it's still quite useful. And it's the kind of thing that research can add a lot on. And this is basically a so-called Taylor rule they're using, but it doesn't really matter. Other kind of rules could be done. And if you just look at this matrix, you can imagine a diagonal And most of the good points are to the upper left part of the picture. So that's a inflation gap coefficient a little greater than 1 and not too large a coefficient on output. So that's the kind of thing that can be done even without a model. Now, there were lots of other things that use models. And one example is this paper also presented at Chicago, Bernanke, Keeley, and Roberts. And they look at a bunch of different rules, Taylor rule at the top, flexible price targeting rule, Reich-Schneider-Williams rule, which is a familiar one, I believe. And they looked at these rules in different kinds of models. And I think it was productive. Again, it was before the recent crisis. And so it's an example of all the work that was going on and trying to evaluate rules, whether with models, without models, using history, and of course, using different countries as well. So that's just an example of something to take a look at. Now, what is also very important, it seems to me, is as this research was going on by scholars, academics, some involved in policy, there was also a move to include more of a discussion of policy rules by the Fed. And so starting in 2017, they started to have a section of the Monetary Policy Report, which is issued twice per year. And so 2017, it was the end of the year. 2018, they had 2. 2019, they had 2. And 2020, they had 1. And this is what they have in the table. And so the first one is a so-called Taylor rule, the balanced approach rule, which is a larger coefficient on unemployment. You have a Taylor rule adjusted for the zero bound, price level rule, first difference rule. And so these are the ones they chose, and they evaluated policy with this. So in some sense, this is significant because really for the first time, the Fed was, of course, they had looked at rules before, so way since Greenspan. I remember the first time I presented policy rules at the Fed with Greenspan was the chair, but this is where they actually put it out in practice. And I think that was towards the end of Janet's term and continued with Jay Powell. So I'm going to come back to this in a minute. This is just a bigger picture. It's hard to see this little thing at the bottom, so it's a little picture, but it's the same thing. It just indicates the different rules that were examined at the time. Now, there was also, and this is a picture of the actual interest rate, which began to move up. You can see it was low. It was low compared to the range that the policy rules would indicate. That's the so-called green line, and a range around that. And the policy rate was low, but it started to come up towards the level, and it was into 2018. And that was another sense in which the Fed, I think, was changing, reacting, and that's an example. And then just maybe a little bit of the history of the leaders at the Fed. So back in 2017, Janet Yellen began to describe this strategy, quote, "When the economy is weak, we encourage spending and investing by pushing long-term, short-term interest rates lower. The economy is threatening to push inflation down the road, we increase interest rates." So that's a rule. And she compared that with the so-called Taylor rule the next day. And then in July of that year, that's when they first began to put these rules into the Monetary Policy Report. And then Jay Powell replaced Janet Yellen as the chair. He did the same thing. He basically continued with this section. In his first testimony, he said, "I find these rule prescriptions helpful." Larry Kudlow is a commentator, still is actually, but he was in the White House at the time. I've never seen that in testimony before. In March, the Fed had a new site on policy rules and how policymakers use them. And of course, the monetary policy reports continued. So I emphasize this because it's the way the research is being followed and used in practice, and it's a more public version of it than existed before. So that's the deal. Now, one thing that's interesting to me is why was this revival of interest in interest rate rules, or rules more generally, occurring? I have a few quotes. Raghu Rajan was the governor of the Reserve Bank of India. "What we need are monetary rules." Mario Draghi was the president of the European Central Bank. "We would all clearly benefit from improving communication over our reaction functions." And this is the same thing I mentioned Jay Powell said before, that he found these helpful. So I think to some extent it was the revealed preference of the policymakers that they saw the advantage of a more systematic approach. There's also the zero bound problem, which I think generated more interest, because if you have the zero bound, which we do, of course, less in some countries, not very much in the US, we're not going below zero. But it raises questions about policy. Should policy be different when you're at the zero bound? And a natural way to do that, many have done that, is with a rule. What's the rule like if you're stuck at zero or stuck at 0.25? And how should the whole problem be adjusted because of that? And so that's another reason why I think there was a revival. How are you going to analyze this zero bound problem without some notion of what you do when you're at the zero bound and how long you're there? I think was also the Great Recession. There was a lot of criticism of why it occurred, some of it by me, to be sure that the rates going into it were a little low. They encouraged speculation, but it did indicate, well, maybe we should have paid more attention to the rules, like when Greenspan was the chair. I just would also mention that the quantitative easing, of course, is now a big issue. I'll come back to that. And there was an effort to consider quantitative easing, the amount of purchases of securities the Fed engages in, was more rule-like. So maybe we should have a rule for doing that. And it's harder to do for sure, because it's not quite so specific as with interest rate. But there's money supply rules, there could be interest rate, there could be rules for the instruments as well, and people did that as well. And then I think the last thing on my list, which maybe is already forgotten, but there was a lot of legislation coming out of the Congress, which was asking the Fed, there was the draft legislation, was the Fed should describe its policy rule, and it could change it. It wasn't say you had to follow our rule. It wasn't like a Hinterling-Graham rule, whatever it happened to be. But the idea was the Fed would do it, but they should describe what it was. And so there was a lot of discussion about that. I don't think the Fed was terribly enthusiastic about this, but that also generated some of the revival, because in practice, there was a lot of discussion about how this would work in practice. And, it's not easy to go from an equation to a law. And it's not easy to preserve the flexibility that we think is important for emergencies. So anyway, those are some of the reasons why I think there was this revival of interest in policy rules. Now, we come to the present, because that interest was thwarted by the pandemic. And we had, I think, this great retreat from policy rules, much less talk about it, and starting in the first quarter of last year with the COVID-19. A huge jolt to the U.S. economy and to the world economy. I'll come back to that as well. Now, this interrupted the revival, and I think that was a factor. And what are you going to do? This is an emergency situation, and so the Fed did a lot of things. And I'll mention the actions. There's a rapid reduction in the federal funds rate. From where it was a little over 2, then it started to come down, went down to 0 to 0.25. Let me show you a picture of that. There it is. It's from the St. Louis Fed. You can see the interest rate was up to 2.5 and started to come down and went to 0 to 25 basis points. Both M1 and M2 measured started to grow very rapidly, much more than the past. There's a picture of that. That's M1. Going along in a whappo, it just goes dramatically fast. And the same with M2, very dramatically fast. And so these are in the data that the Fed publishes. And let me also mention, I mentioned the decline in interest rate to 0 to 0.25, but there was also the change in policy was represented in the so-called dot plot. And this is a dot plot from June of 2020. And you can see it's basically 0 to 0.25, between 0 to 0.25 through last year, through this year, and through much of this year. A couple people were deviating, but not by much. And then eventually there was no statement of what the long term is, but it would then rise to, say, 2.5%, or depending on the viewpoint of the FOMC member. And so those are two things that occur, the interest rate and money growth. But The third, which is a dominant issue today, is these large-scale purchases of treasuries and mortgage-backed securities was tremendous. And that's increased the assets of the Fed by more than doubled. I have a picture of that. There it is. And so this is from Fred from the Federal Reserve Bank of St. Louis. And you can see that the total amount of assets just exploded last year, and it's continuing. That's the $120 billion a month proposal that's actually in action. It hasn't changed yet, but there's talk about the Fed changing. I'll talk about that in a minute. So a huge change occurred in these four different ways. The other thing which is important to note is for the first time in all these years, the Fed didn't report on rules in this monetary policy report, so it didn't include them. I thought that was a big change, and it was fixed pretty soon, maybe because of various people complaining, but it was fixed. But I think that's an action that was taken that represents the retreat from policy rules, was the actions and the reporting that was done. So those are some evidence. Now, what's also interesting that occurred at this time is many central banks began to review their strategy, and the Fed included. And Jay Powell presented a paper back in last year, August 2020, at the famous Jackson Hole conference. And this is where they introduced this more flexible form of average inflation targeting. Things like the Taylor rule already had an average, but it wasn't a long average. It was just a year, 4 quarters. And the idea was if we had a longer inflation targeting period, then we could have some high inflation, maybe 2.5, to offset the 1.5, and that average would work out. So that was proposed in August of 2020, and I think that it's being implemented, as we'll discuss. The other thing that happened is the Fed policy decisions were to be based on these shortfalls of unemployment from a maximum level rather than deviations. So that means if the unemployment rate went very low, there wouldn't be a tightening of policy, and we'll talk about that as well. But that was the difference. And so both of these are proposals that have to do with, I think at least, changing the policy rule. And the question is whether they work or not. I mean, they are rules-based, which is good. I also think it's important to note from a global perspective is that other central banks didn't leap into this approach right away. Bob Morrison, who's an expert in Germany, he's studied the ECB. He said they're not blindly following the Fed's new strategy. So from a global perspective, I think it's still unclear to what extent this new approach will be followed. And so far, it's really not. Okay. The specifics then, which I will elaborate on briefly. So in February of this year, and it repeated in July of this year, the Fed returned to having monetary policy in its report, and it was only dropped in July of 2020. There were 5 rules that they looked at and reported on, and one rule was added in. I'll talk about that in a minute. One rule was taken out, one rule was added in. We can see why. And as the Fed described this, and I'll look at the rule in a second, this modified simple rule, which I'll look at in a minute, would not, I'll quote, would not call for increasing the policy rate as employment moves higher and unemployment drops below its estimated long-term level. This modified rule aims to illustrate in a simple way the committee's focus on shortfalls of employment from assessments of its maximum level. So that was meant to be a change. Now we can see the change from the Fed's reports. I think, yes, okay. So this is what it looked like, and I showed you this a few minutes ago. This is what it looked like in February of 2020 before they took it out. And so it's the same thing. So what they've done, and a good question is why, is they got rid of that price level rule. So that's not there anymore. And they replaced it with this thing. It's called the balanced approach shortfalls rule, just to be sure. That was gone. Price level rule must not have liked that very much. And they included this balanced approach shortfalls rule. So the balanced approach first reflects the fact that the coefficient on the unemployment rate is higher. So if you compare the first rule with the second rule, the main difference is it's a higher coefficient of unemployment. And so that means the Fed moves the rate around more if unemployment changes. But the shortfalls rule is even different than that, because what that says that you'll choose the minimum, 2 times the minimum, of course, of the difference between the long run level of unemployment and the actual level of say it's so, like, for example, suppose the long run average is 4 and the unemployment is 3.5. So that would normally be saying, according to the balanced approach rule or the Taylor rule, that we suggest a higher interest rate. But no, because the minimum is 0, you don't make that change. And so this is a sense in which it's shortfalls. And that's a different rule for sure. And it's going to be tested pretty soon, I believe, as we go into the future. Otherwise, it's the same. And, for example, this so-called adjusted Taylor rule is really based on John Williams' work. The effective lower bound could be 0.2, 0.5, could be 0. And the Z is the accumulation of past errors. So you basically, if you're below 0 for a while, you accumulate that through this term Z. It's a modification, algebraic modification. So I think that this is a valuable contribution that they're studying this and having people like us think about it. Just as an example, you might want to say, what difference does it make? And so this is a picture, actually a blown up version of what the Fed has provided. And the main thing is to look at is 2017, 18, and 19. And you can see the shortfalls rule, this is the interest rate, doesn't rise as much as the balanced approach rule because the inflation rate, the unemployment rate goes below 4. The balanced approach rule is a little larger. The one in the middle is the so-called Taylor rule, but and then of course, they're all quite different during the pandemic, which occurs in 2020. But that's it's not a huge difference, but it's a factor in calculations. Okay, now, what I want to do as we think into the future is to think about not only the rules in the Fed's book, in the Fed's reports, but the strategy for using these. And this is a very important in the future, and just the Fed met this week, and I'll talk a little bit about that, where it's going. There's a lot of talk about whether it's changing or not, and changing the direction that I've been urging. But apparently the decisions are not yet part of the strategy. And the question is, yes, it's good they're in the report, but there seems to be a discrepancy. And in the meantime, and I'll talk about this, the economy is recovering, and many policy rules, including the ones in the Fed's report, are indicating there should be higher interest rates. And it's the US is recovering, and so is the rest of the world. Not every part of the world, unfortunately, has still a lot of serious problems, especially in Africa and Asia. But the question is, should we be adjusting more in this apparently, hopefully, post-pandemic world? So let me first just give you some data that indicates this may be recovering. This is GDP. You can see the collapse of GDP in the first part of last year, and then the recovery, we're pretty much back to normal, not exactly, a little bit short, but it's quite a recovery. The recession itself was only 2 months, very, very shortest recession we've ever had. It's marked by the Fed. And so that's a sense in which we are coming out, and we need to have policy adjusting. Even if you thought it was completely correct to move off the rules, we should be moving back, it seems to me, based on research in academia and at the Fed. I want to also just mention a little bit how this is global. So this is a map produced by the IMF, and it's the growth rate for countries in the world back in 2019. And I don't see too many things that are below 0, a little bit, but not much. Then you had the pandemic, and everything went negative. The US, most of Latin America, Russia, China lower, but not negative, much of Africa. And so that was where we were last year. And then here's where we are this year. So this again is the IMF, the IMF is studying this. And of course, poor Venezuela is still in trouble. Myanmar is in trouble. But it's a completely changed world from here to here. And so I think the policy obviously needs to worry about, we'll go back to that. But in the meantime, we don't seem to be going back, and we seem to be making progress. So that's the reason for the change globally. I just mentioned this offhand because it's another talk, really. But in the meantime, policy is becoming very different in both fiscal as well as monetary policy. And many people are thinking about we need revisions in monetary theory. Modern monetary theory is an example. And you can see this is the projected debt of the US, and it's way up. It's projected to go above World War II levels. And so that's a concern for monetary policy, but it's something I'm not addressing in this particular talk. But I think it's important to think about this relationship between monetary policy and fiscal policy. And there's lots of commentary about that. These are decisions that are still underway. Now, so what I'd like to do is, in the last part of this discussion, is to think a little bit about the policy rules for the interest rate versus the actual decisions that are being made. And their decisions are changing even this week as we speak. So there's some anticipatory effect. So first of all, I have a chart, which I'll go to now. The chart is a blue line, which gives the FOMC's projections of the federal funds rate out to 2023 fourth quarter. And then it looks at three different rules. Now this is a projection right before this week. And so this is the picture. And so the flat line is the estimate of the Fed. There's some dots which are somewhat off of this, but this is the average. Along with a policy rule. Now this just happens to be the so-called Taylor rule, but with different inflation rates in it. It also has the equilibrium interest rate as 1 rather than 2. One of the big issues for the Fed and for monetary policy in general is, did the equilibrium interest rate fall? And there's been research on that at the Fed. And so this basically says, okay, let's assume it fell from 2 real, which is originally what I thought and others thought, to 1 real, which is, I think, it may be a better estimate of what it is. So this assumes 1, so the rate is lower on that account. In any case, that's why the rate goes up to 3 rather than 4. But nonetheless, you can see here we are in 2021, and we're below what this suggests. Not a lot below by this measure, but I say 1 to 2% below. And then as we go into next year, 2%, and 2023, even lower than that. So this is a sense in which this is a standard policy rule. The Fed is a little low, using different measures of inflation. And so the question is, should we be revising the rules? Should we be changing the rules? Or should the Fed be catching up? We don't know. But here's one way to think about it. I want to consider alternative ways to re-enter than this. And I want to do that by considering some of these rules that the Fed has proposed. So I described the shortfalls rule, and they did that relative to the balanced approach. But you also can do that relative to the Taylor rule. So you can have a Taylor shortfall and a balanced approach shortfall. And in both cases, what you're doing, it says in the slide, you're replacing the difference between the unemployment rate in the long run, the actual unemployment rate. You're replacing that with the minimum of the difference in 0. And so, for example, in the first fold, if the unemployment rate is 3.5 and the long run level, so the natural rate is 4, you don't raise the interest rate. You would normally raise the interest rate according to standard policy rules. But in this case, you don't, and you leave it at 0. There's no change. So that is because 0 is the minimum of 0.5 and 0. And so that's in a sense in which you don't, you just look at the shortfall with respect to both of the rules. The other thing which, and the Fed has talked about that already explicitly. The other thing which is an interpretation of what the Federal Reserve is doing, and this is called consistent rule, and that is to say, well, let's not think the target is 2% or even 2.1%, because we may be higher. We may have to offset the fact that it was 1.7 or 1.8 in the past. So this basically says that, well, let's assume it's 2.2, and so there's no adjustment if inflation is up to 2.2. Over 2.2, it's different. Now, we don't know exactly what it should be. We're guessing as researchers. The second thing, which this consistent thing it does, is assumes that the equilibrium real interest rate is only 0.5%. It was 2% in the original research, and then 1% is in the chart I had. Let's assume it's 0.5%. And so that's even lower. And then finally, let's have the target unemployment rate be 3.5 rather than 0, so then we don't get into the shortfalls issue so much. So I want to look at the period from the fourth quarter of last year to the fourth quarter of next year, of 2023. And this is the picture. Okay, so first of all, this first picture is just a replication of what I had before without 2020. So it's a comparison purpose. For comparison purpose, you can see we're 1 to 2% below in 2021, and we're 2 to 2.5% below in 2022, assuming there's no changes, and we'll talk about that before I finish. So that's just a replication of what I showed before. This is the three different rules. The so-called Taylor rule, the Taylor rule shortfalls, and you can see when the unemployment rate gets very low, we don't raise the rate. That's out in later 2022 and 2023. These are based on forecasts of the private sector or the Fed. And then finally, this Taylor rule, which is consistent, which basically lowers the inflation rate that you're targeting. And so you can see now, even with these changes, which are in the direction that the Fed has indicated, we're not as far off. In 2021, towards the end of the year, we're about 1% or 1.5%. But then it continues, and maybe next year it's 2.5%, and close to 3%, depending on your analysis into the latter part of 2023. So it's still low when you again approach this with the kind of things that the Fed has said, for example, the 0.5 equilibrium interest rate. Then finally, this is the same thing with the balanced approach rule. That's with the higher coefficient on unemployment. In this case, looks like you're not too far off right now. And it depends, if you have the lower inflation rate target, lower unemployment rate target, but if the story is the same and you're off by, say, 2 to 3% at the end of next year, or 1 to 3% at the end of 2022. So all of these are suggesting there should be some re-entry into the future. And this is what I've been writing about and talking about. I think it's important. And again, it's based on the research, but it's research as applied to, in this particular case, the Fed. And it applies to other central banks as well. So it's truly global. Now, one thing, then I'll just maybe conclude at this point, if that's okay. There has been changes. And so so that's the chart I indicated from last year. And these are the so-called dot plots that the Fed has put through. And it was basically 0 except for 1 or 2 people in 2022. And then we don't know when the longer one occur, but looks like they want to go to 2.5 or so. But the change is here. This is just released. And you can see this doesn't go quite as, this goes out a little further than 2022. And you can already see that the rate is still pretty close to 0 in 2022. But by 2023, and this is the average of next year, the average rate it's actually 9 above and 9 below is 1%. And so we see 1% in 2023 and even higher in 2024, not too far away from the longer run level. So it seems like the Fed is beginning to adapt in this direction that I've indicated it should, but it hasn't yet. And these are all future. This is the future. The Fed is still at the same level of interest rates, and it's still the same amount of quantitative easing, the same amount of purchases of treasuries that are spent. But the signal is that it will begin to change, and I think that's good to give a signal. But they haven't done it yet. They could reverse if you like. So that's the story. It really is up to date as I could possibly make it. And then finally, let me. It looks like Laura's coming on and tell me to shut up. So let me just. No, okay. You're just coming on anyway. Okay. So let me just summarize a little bit and then conclude. So this I tried to do here was consider the different rules, the Taylor rule with different inflation rates, and compare it to where we think the Fed is going. And we could raise it a little bit based on what happened this week, but it's still quite low in not only into this year, next year, and 2023. But it's also low if you use the balanced approach rule with those modifications that of a lower inflation rate, lower equilibrium real interest rate, and it's as much as 3% lower in 2023 or 2.5% in 2022. So it doesn't make a lot of difference, and I think that that's why I think that you think about this from a robust perspective. You see that there's quite a lot to be said here about beginning to move, and we don't. Of course, the Fed hasn't moved yet. We'll see if they will do what they're talking about. Now, finally, let me just conclude, if you don't mind. I'd like to conclude. So what I've tried to do in this paper is examine the reasons why we should return to rules-based policy, and it works pretty well. We're going to a place where inflation might be rising. It's a time to bring back to normal, and I outlined a method to do so. It's not radical, but it's in a direction which the Fed could already be moving. We looked at the 5 years leading up to the present situation, and I think that's important because it's a tremendous amount of background in analyzing, which is done in the central banks plural, and as well as academia. And what this shows is the Fed should start now on a rule in which markets understand. They say this is what we're doing. It raises the policy interest rate if growth increases and inflation rises, and they're both increasing now. It's a contingency plan. All rules are contingency plans. They can change if the circumstances change. I think the fact, and it's promising in my perspective, that the Fed has changed already its monetary policy report this year, both in February and July of this year. And so it's preparing for such a strategy in practice. I think that if the Fed could explain how its policy rule would be consistent with the flexible average inflation targeting, and I've shown that it is. It's flexible average inflation targeting means you take the average over more than 1 year, 2 years, 3 years, but they could clarify what that is. But in any case, it doesn't seem to matter so much. And I think this would remove uncertainty, would be better for the recovery. There's, of course, uncertainty about whether the pandemic will come back, what's happening in the poor parts of the world. But it seems to me this is a direction which is positive for the U.S. economy and therefore for the global economy. So I'll stop there, see if there's any questions. Thank you, Laura.
Thank you, John. Sorry, I didn't mean to rush you at all. I just, there are lots of questions popping up.
Okay.
So I'm gonna take the moderator's prerogative and ask you one first. And then what I'm going to do is I'm going to go down the Q&A list just so that everybody knows what to expect. And I'm going to allow you to unmute if you've asked a question sequentially. And so you can then you'll see the moderator has allowed you to unmute. You still have to hit unmute, I believe, and then you can speak up and ask your question personally to Professor Taylor. So let me kick things off. And you pointed out that there's a lot of new policy tools that the Federal Reserve is using. For example, we see a lot of QE, right? You showed us the enormous balance sheet. We have more forward guidance being used now than in the past. Should these new tools have rules as well? Sorry, John, you're still muted. You have to unmute yourself.
Is that better? Okay.
Yep, now I hear you. Thank you.
I think the forward guidance is important. It's really consistent with stipulating what your strategy, what your rule is. And I think I was quite positive about the legislation that was in Congress, and that's really what it would do. There's different ways to do it, but the dots are in that direction, forward guidance. So I think it's good to do that. And maybe that's what you're seeing more of in the last week or so, because there's an indication of where the Fed will go. I think so quantitative easing is a very interesting subject, and there's a lot of it going on. They're buying treasuries and mortgage-backed securities. There's this hint which they'll begin to discontinue it, to stop sometime late this year, early next year. I think that this is a very important research topic. I've found that there's real questions about the impact of the quantitative easing. It makes monetary policy much less interpretable. The analysis of how much rates have been lowered, if they have been lowered by this. The alternative is that the Fed lays out a path, say, for the short-term interest rate or for the money supply, but say the short-term interest rate, and based on that, traders figure out what the long-term rate should be. And of course, they're guessing what the future short-term rates will be, and that's where forward guidance fits into the question. A good forward guidance policy does a lot in determining the other interest rates in the economy, and you may not need the quantitative easing. We didn't have quantitative easing before the great financial crisis. It began, and then it phased out, and it began again. And I think that's probably one of the most important topics for research. It's hard, and if you're in the markets, you're seeing every day what the Fed is doing. You can see movements. Spend a lot of time in the markets myself, but it's not so easy to interpret what the impacts are. But I'd say I would prefer if the Fed began to unwind that. Right now, they seem to be saying that they'll unwind that first and then do the interest rate increase. I don't really particularly see the reason for that, but that's what they're saying.
Okay, thank you. So our first question comes from Kim Schoenholz. Kim, I've allowed you to unmute yourself, so you should be able to speak up and ask your question.
Thank you very much, Laura. And thank you, John, for that excellent presentation. Very grateful. The ECB recently updated its strategy as well, about a year after the Fed's. Differently from the FOMC, they did not introduce an explicit makeup strategy to offset past inflation misses. How significant is the difference? Does it matter for price stability?
I think it does. I think the ECB was reluctant to go in this direction. As I mentioned, Maurice was a commentator, and he thought it wasn't the best way to go. So it's not surprising. I think what I would like, if there's a makeup strategy, it seems to me being more explicit about what it is would be good. So, for example, the makeup strategy might be we'll consider the average inflation rate. If it's over a year, that's no different. I think that's what they've done. If it's over 2 years, over 3 years, then you might have a 2.2%, 2.3% inflation for 2 or 3 years to make up for 1.7 or whatever it was in the past, 1.6. So that would add to it. And now I think the ECB has just decided that's too hard. Let's just stick with our target inflation. There's always a question of averaging, because you don't want to, as you know, you don't want to react to the monthly rate all by itself, monthly inflation rate all by itself. So you always want to be averaging. And I think that's why the ECB has been reluctant to do this makeup strategy. I think it's a little vague, quite frankly. How long will we be above 2? The 2.2, which I used, is just an estimate, and that came from some of the work that Rich Clarida had talked about, but it's just an estimate, and there's nothing in the card. So I think that's a reduction in the certainty that has been introduced, and I think the ECB is right to be a little cautious about that, and maybe the Fed will be more specific about what the makeup strategy is.
Great. Our next question comes from Hugh McCullough. Hugh, I've just allowed you to unmute.
I think I'm unmuted. Am I on?
We hear you. Yep.
Hi, you. Yeah.
Did you want me to ask the question, or?
Yes, please.
Okay. I've written since late 2008, the real Fed funds rate has been persistently negative. So why, from the perspective of the Taylor rule, hasn't there been accelerating and even runaway inflation even before the COVID crisis? I mean, if low real interest rates accelerate inflation, we've got really low real interest rates. Why hasn't inflation been accelerating?
Well, as you know, the Fed began to adjust rates before the crisis hit. The 2008 was a very big crisis, and then they were slow to come back. And then you see inflation picking up, I think now, quite substantially. And so
the last couple of months, there's been
well, there's
and before that there were a few little spurts of high inflation, but the Fed funds rate hasn't been much above 2. It's mostly been around 0, and inflation has been running almost 2, so it's basically a negative real rate pretty persistently.
Yeah,
which is conceivable. The natural rate's negative now. Is that the?
You mean the R-star, the equilibrium?
Yeah, the VIXL natural rate that.
Yeah, it could be. There's people have done work on that, a lot of work on that. I tend to think there's a tendency for the current rates to affect that. I don't really think it's negative. I mean, of course, we have negative rates in Europe and in Japan. It doesn't seem like it does a lot of good. But I'd say at this point, say make it 0.5, make it 1, and you still need to raise rates, right? You still need to raise rates. And it wasn't that the Fed began to raise rates in 2017, 18, and 19, and then it sort of fell back again. Also, I think it's important I've written about this, others have too, that the rate going into the global financial crisis was quite low. And there was questions about whether the acceleration before that, before 2008, which you mentioned, 2005, 6, 7, was one of the reasons that we have the exuberance and the over acceleration that led to that crisis. There's debate about that, but I've written about it myself. Again, going back to policy rules, the rate was quite low at that period, and there was debate about the reasons for it. So I think looking over the longer period, and I want to say I think the focus on money growth that people are looking at is important. Money growth is high. By the way, I don't know if you noticed, I'm very proud of this. In the back of my picture is a California license plate.
MV equals P Y or T?
It's PY.
PY.
It's and the M and the V are real California numbers. The P and the Y are real California numbers. The equal sign is 2 pieces of tape. And these were Milton Friedman's license plates. He had them on a BMW convertible.
With the tape, with the equal sign?
Well, I have this, the tape story is what I remember from Milton. The California Highway Patrol didn't like the 2 pieces of tape, so they made him take it off. He took it off for a day and put it back next day. I don't know if it's 1 day or 2 days or whatever, but this is the version I had. Anyway, so there's other rules to have, and we need to be open-minded and do our research on it. But I think going back to your question, the problem with interest rate rules is what should the equilibrium interest rate be? I think there's lots of research on that, and I don't think it's negative. I think we haven't had the greatest experience in Europe with the negative rates. And there's other issues, of course, is income distribution. There's how the financial markets work. Can they deal with negative rates very well? And so I prefer if they were a little higher. We have the rules. We have inflation picking up. We have the economy almost back to normal, and you can see where we are and where we were. We were starting to get back before the crisis hit. Anyway, good question. Sorry.
Well, thanks.
Great. So our next question comes from Cam Leong. Cam, can you unmute?
I don't know. Do you hear me?
Yes, we hear you. Great. Go ahead and ask your question.
Yeah, I was wondering, cutting rates to near 0 all these years, they really hurt the retirees and food and energy prices keep going up, and that's not counted in the inflation. Well, that hurts the poor more than anyone else. So, and they don't even have any small savings to help them on that. So it was really, I guess, a big bash on the savers, and it's creating asset bubbles now. So, well, just want to know, are they playing like politics to use stock market as a measure for success?
Yeah, I think that's a very good point. The monetary policy affects a lot of things, affects individuals, affects income distribution. And so that's the reason I think personally I have a rule or strategy which is clear to people, and you debate what it is. It would be legislation, it would be better. And you can have these discussions as part of the description. You know, how much should the interest rate change with respect to the unemployment rate? There's debates about that. Should the coefficient on the inflation rate be larger? Certainly, I think it should be greater than 1. And so this is very much the case. But interest rates, as you can see in this recent discussion that we've had, are more than just the monetary policy. They affect all sorts of other things in the economy.
Yeah, are they creating asset bubbles?
It could be. I don't know for sure. I do know the rate is low compared to the state of the economy, state of inflation. Basically, let me say this: inflation seems to be about 4%. If you take about, say maybe unemployment is higher than normal, take some stuff off for that. And
that could be due to the technology that's keeping the prices, the wages low. That's keeping the inflation in check, isn't it?
So let me say that there's all sorts of people saying that the inflation rate is high temporarily and don't worry about it. But we've seen this story before, and there's no reason why there couldn't be some moves that take that into account, take the uncertainty into account. But a lot of people are talking about the higher inflation rate. It's not a mystery, and the people at the Fed has said don't worry so much. It's because it was low last year. It's sort of bouncing back a little bit, but that has been said before. I just have something here I want to show you.
Yeah, the question is it transient or not? I think some of the increased prices are going to stick. They're not going.
Yeah, I think they will. But we've been through this before. Let me hold this book up. This is a book that it has me there, but it also has Milton and George Shultz. And I published this with George last year before he unfortunately died at age 100. And we described what happened in the 70s. And here, the chairman of the Fed, Arthur Burns, was saying, it's not monetary policy. Inflation has got its own roots, so we can't do anything about it. And it was completely wrong. And inflation rose and rose and rose. So you got to be careful. I think democracy is important, where there's very people can kibitz about what the Fed is doing. And right now, I mean, the decision recently was unanimous at the Fed. I'm not quite sure all the reasons for that. I'm not there. Some of the people, like John Williams, Rich Clarida, Randy Quarles, have done a lot of work on rules and strategies. So
I think in the 70s, it shot up because they had the war and they had a big social program and they didn't raise taxes. That was the reason for the high inflation in the 70s.
Well, I'm glad you're so sure. I'm glad you know, but I think it was monetary policy, but we can debate that next time or something. Have a seminar on inflation in the 1970s. But
the main thing is they haven't raised taxes to pay for it right now. I think it's the common.
Well, I showed you the picture of the debt, which is another question for sure.
I have one more question. I don't know if I can throw it in. These cryptocurrencies, isn't that the same as like counterfeit money getting thrown into the system? Because it's not backed by anything. They have no intrinsic value. It's like just people just throwing things out and then they're trading in the good money for the good fake money. Isn't this like counterfeit money? Is that going to be ultra inflationary in the future? Everybody keeps making cryptocurrencies.
I think it's a good thing to have these alternatives, and of course it does require that the Fed or the central banks consider the total supply of money that's occurring. But you know, one of the things that I think is encouraging is globally, many countries don't have much of a currency and they're using the dollar. Is that the best thing to have? There's a, recently countries are trying to issue Bitcoin instead. I think it's good. I was a part of a firm once that they didn't do too well because they got regulated out of business that was trying to do this. So I think that this is something that this is using the technology in a way that could be quite beneficial. We don't want to crowd it out and say it's illegal or something like that, which I worry about doing. But find a way to have it a part of the system. And maybe because of the pandemic, I don't use currency much at all anymore. Probably people are the same way. But for international transactions, I think it could be better.
But there's nothing backing it. They've got no intrinsic value. That's what worries me. At least the dollar has something backing it. We have our
GNP has something. The dollar has the Fed.
Yeah, or in the cheapest shit, you just look at the real estate of the U.S. government. It's like Greece was when they went under. I think all the debtors actually own Greece, but at least there's an intrinsic value, something you could put on this. This is totally imaginary.
I'd like to give a few other people a chance to ask questions as well.
Wait for that reply on this one, and I'm off.
Our next, do you have more to say on this topic, John?
No, this is a good discussion.
Okay.
Thank you.
Okay.
We have to have another lecture on cryptocurrency. That's fascinating.
Absolutely, that would be fascinating. So our next question comes from Patrick Kehoe. Patrick?
Hi, John. So if I think of your favorite...
Patrick, where are you?
Palo Alto.
Okay, good. That's where I am.
A few blocks from your house.
Okay. Good to see you.
Good to see you. Two things I got from your two things people are worried about. I take it from what you said. If the Fed continues on its current path without adjusting closer to your favorite Taylor rule, inflation will be higher, like in 22 and 23. And then you mentioned just more general uncertainty. So mechanically, if you were using your favorite version of the Taylor rule and you went out a couple of years, say 22, 23, and you said mean inflation under your rule, and if the Fed muddles around and continues, this is a little looser, something close to what it's doing without adjusting as much in the direction as you favor, with some of these allowing not adjusting as much up as you would say. What is the ballpark of what the difference in inflation is? Is it 1%, 2%, or is it a small amount? It's a bit vague because the Fed, we don't know what the Fed is doing.
It is vague, Patrick. Inflation's picking up now, and you can say, well, don't worry about it. It was low last year, but it's 3 or 4%. That's the Fed will have to adjust, and unless they've completely changed, they say 4% is fine. But and the question is, do they adjust rapidly? Do they adjust slowly? Experience before when inflation has got too high is that reaction has been negative to the economy. And so I think this is where you don't want to surprise as much as possible, be consistent or rules-based if you like. And I think it's not too late, but I do think it will be too late soon. And I don't know for sure the size of the inflation increase, but all of the models, all of the studies, all of the, then there's these other things like bottlenecks and supply constraints and what the situation is with respect to the workforce. So there's uncertainty. I don't see why we can't be more typical, more regular in setting the policy. That's the basic idea.
If you use the current Ford guidance and you plug it into one of your models, favorite models, and use that versus your favorite Taylor rule model, do you have a ballpark of the difference we're talking about for inflation in 2022, 23?
So inflation will pick up. That doesn't mean it will go above 4 because we're still, going up towards that. But it will pick up, and you could see that a little bit in my charts. If you plug in the average interest rate for next year is about 1. And you plug that in, it's still well below 2.5. And so all of the models that I use and others use, who says that will stimulate too much, so to speak, and the inflation rate will pick up. So you can use, classic models and get an estimate for that, but it's definitely positive. And the worry is it gets too high, and then there has to be a reaction. I think it's much better as you move into a new situation of say 2% inflation, a new situation of employment close to the natural rate. It's not rocket science, and the interest rate is a question of what's the normal rate? Should it be 3? Which would be a 2% inflation plus 1 real? Should it be less than that? That is an unresolved question. I think the charts from the Fed indicate it's slightly less than that. And the Taylor rule had 4. I think 4 is probably too high given what we estimate the R star to be at this point. So those are the considerations, but they all point in the direction of let's get on with this. And just to be sure, the decisions the Fed has made recently may be in that direction. I just don't know. It could reverse. I don't know, but the people I know and the discussions suggest they're going in this direction. It worries me. It's good they changed this week, but it's not clear they've changed enough.
Thank you.
Sure.
Okay. So our next question comes from Richard Berner.
Oh.
There we go. Yep, we can hear you.
Okay. Hi, John. Thanks for an excellent lecture. Really appreciate it.
Sure.
My question is, you alluded to some financial stability implications of monetary policy. And my question is, how, if at all, should those be incorporated in policy rules?
So I've thought that it's best to just think about the macro variables, say inflation, unemployment. There's still debate about what the real rate would be. But I think in terms of the stock market, I think the bond market would take care of itself at that point, not perfectly, of course, there'd be speculation. But I think the stock market, you're sort of leaving it alone, leaving the profitability, leaving it to the real sector of the economy. So that's what I wouldn't worry too much about that. I know many people are. I think the other thing is, which is, you didn't mention this, what is the real growth rate for the economy? Where should the Fed be concerned if growth is 4%? Should it be concerned if growth is 3%? Is that too rapid? I think there you're talking about the rest of the economy, the rest of policy, and I'm a little frustrated that we haven't talked much about that. We sort of talk about the pandemic, and even before the pandemic is potential growth 3%, 2.5%, 2%, and I would like policy, other kinds of policy, to focus on that. And then, of course, you're raising questions about income distribution. That's a whole other kind of policy. There's discussions about whether the Fed should be involved in that discussion. I think not. I think the Fed has enough to worry about. And there's other policies which we should be debating to deal with that. But I think that, again, my sense is from thinking about this and talking to policymakers over many years is that don't make it too complicated. It's already complicated enough. And there's other parts of the government. I think the too big to fail issue, other regulatory issues with respect to financial firms are where we should be focusing on that. Anyway, hope that's helpful, Richard.
No, thank you. But could I follow up with a question about the so-called intercept and your question about real growth? If people perceive that, for whatever reason, productivity is accelerated or other things, or we've come out of the pandemic in a way that we hadn't anticipated, should that be reflected in the intercept for the policy rule? Should it be raised, for example, and how would you adjust it?
Yeah, I think it's the intercept in the sense of what's the potential of the economy? Is it much higher than we are now? I think you have to be. I am optimistic. It's higher than we think. I'm sitting here in Silicon Valley, and I'm thinking of all these firms which are global, and they're being attacked all over the place, but they're still trying to produce in new ways. And we're seeing online. We're seeing this thing. I'm teaching thousands of students online last quarter, and you can see that it's really affecting what we do. And I think here the regulatory side has to be just right. But I would say let's assume it's higher for monetary policy, and we can always make adjustments later. But it's not. It needs more attention. I wish more generally there was more attention to that. Regulatory policy, education policy, that all affect productivity. And it's not so much, I think, the regulatory side involves monetary policy to some extent, but I would not be changing dramatically at this point.
Thanks.
Our next question comes from Kyle Governor.
Hi, John. Great talk. So I do have two questions. I'm hoping to maybe ask both. So the first one, it sounds like you're advocating for a rules-based policy. But I'm wondering if you feel like that should be abandoned in times of recession, just like how we just had the pandemic, right? Or do you think the rules should actually be robust enough to withstand these kind of negative shocks or even positive shocks?
So it's a very good question. So the pandemic, you could saw what that did to GDP. You saw it did so many parts of our economy. It's hard to think that we'd be all prepared for every single aspect of that. So I can sympathize with moving away. I don't really fault the Fed for what they did last spring and summer even. So it becomes when things are a little clearer, when things seem to be, say, in the charts I indicated picking up, then you need to be making adjustments. Now, that doesn't mean we can't be thinking of more robust policies. Hopefully we don't have what happened last year again. It doesn't hurt to think about what if we do? How should policy be different? And unfortunately, I think there's lots of debate all over the place, fiscal policy and monetary policy and regulatory policy about what to do. There's differences in the states in the US and differences in the different countries as well. But I think that the more robust, and this is so much for where research could be doing, to how to make policy strategies, rules more robust. Richard was talking about the stability. Should we be thinking about stability a little bit more? I mean, to me, more stability occurs from more clarity, more transparency, but maybe you should be thinking about that. So I think your question about robustness is huge. That's why we have different policy rules that have been out there, that have been proposed. There's debate about it. And it's amazing there hasn't been more debate. I think what's happening now is people are looking for alternatives. That's maybe a rule for QE, a rule for money growth, and they're doing that. That's fine. But the reason why we focused on the interest rate is that's where the Fed was making decisions, and it was easy to have it done that way. But it doesn't have to be that way forever. And cryptocurrency might affect it as well. Anyway, I'm starting to go on and on. So what's your other question?
All right. Okay. So then, because I saw in one of your equations that the Fed seems to be looking at more long-term strategies. But then, based on what you just said, should we then maybe base these rules on more very short-term outcomes rather than thinking like trying to average out on a very long-term scale?
So with respect, I think this is with respect to the inflation measure.
Yeah.
There's no reason why you couldn't consider inflation, certainly more than 1 month, right? You don't want to look at the inflation rate just 1 month. And I chose a year a long time ago. It seemed like a good compromise. 2 years seemed a little long. But there's no reason why you couldn't have 2 years or 2.5 years or 3 years. I think I get worried because memories become an issue and measurement becomes an issue. There's more debates about it. But I think that, again, you want what works the best. And, I think 1 month would not work. You have too much volatility. 1 year may be better, but even there you might have volatility, and you should allow for this makeup. If you had, say, 3 or 4 years, then you could have inflation rate of 2.2, 2.3 to make up for the 1.7. in the past. But I think it's harder, and I think that's one reason why the ECB has not gone in that direction.
Okay. And sorry, last very quick one. Do you think rules should maybe just stay by the zero bound? So should we just base rules, interest rate rules to just stay at the zero bound from now on?
So the zero bound is a very important question. People have done work on it. Some argue we shouldn't worry about it, just have negative 3% or negative 4% or whatever. I tend to think that we should find alternatives. And thinking about, maybe there's one of the reasons for forward guidance is you say, okay, we'll be at zero until the inflation rate picks up, and then maybe that's a year, maybe that's 2 years. So that, I think, is a better way to go about it. Otherwise, you have the financial markets have to adjust to it. They're not exactly clear how they would adjust. I think Europe and Japan has not been the best example. So while I don't want to rule out negative rates entirely, and there's some good colleagues who are working on that, but I worry about it. I don't think we need to go in that direction. I think the strategies where you look at money growth, you look at alternatives, are a better way to proceed.
All right, thank you.
Thanks. So our next question comes from Stan Zinn. Stan, you should be able to unmute now.
Thanks, Laura. John, I want to thank you for your thoughtful words about Dave and for giving such a great talk on an incredibly important topic. So in the middle of your talk, you showed us this graph of the explosion in the Fed's balance sheet up to like $8-9 trillion. And we know those liabilities have a return index to the same interest rate that the Taylor rule is talking about. We used to think the primary effect of the Taylor rule was controlling the cost of capital of the private sector. But kind of now it seems like it might be just as important to think about the cost of capital for the Fed's own portfolio of these fixed income assets. So do you worry that the kind of average yield on the Fed's assets is now going to place an effective upper bound on any interest rate rule? And if so, do you think that, how do you think that's going to affect the effectiveness of the policy rule and credibility going forward?
Yeah, Stan, that's a good question. I think one of the reasons I worry about the volume of the quantitative easing at this point, because I think they have to get out of it at some point. And if those who thought that reduced rates were the result of the purchases, they'll think that higher rates are the result of the smaller purchases. So, and that interferes with policy. You're right. The interest rate is the variable that I think is the better gauge, but it now affects the Fed's balance sheet on the income completely. So it's another factor to worry about. I worry about how the exit from quantitative easing will work. It's hard to do. And again, for so many people have argued it's lowering the rate, they're going to be arguing it raised the rate. So that is the complication you're talking about. And I don't have an answer except just get going, get started with it.
Okay, thanks, John. Perfect.
Sure, Stan.
Our next question comes from John Lipsky. John, you have to unmute yourself. I allowed you to unmute, but you have to hit the unmute button.
But I didn't have a question, sorry. But thanks, John, for a great presentation.
Okay.
Oh, thank you. Thank you, John Lipsky, wherever you are.
Okay, thank you. Sorry, so I hand up and thought there was a question. Okay, I think we've gotten through most of our questions and comments. And I think at this point, we're going to say thank you very much for a really thoughtful presentation, for answering all kinds of questions from all kinds of corners of monetary economics, but giving us some insight and giving us an opportunity to come together as a community and to remember Dave. This has been a really special event, and thank you for making it all possible. So I think in closing, Venki Venkateshwaran wanted to say a word or two.
Great. Thank you so much. And I want to start off by a big round of virtual applause to our speaker, John Taylor, for a fascinating and wonderful lecture. And as Laura mentioned, it spanned so many aspects of monetary policy and has given us a lot of food for thought. I also want to thank Laura for an outstanding job as a moderator, and handling questions like this is obviously not an easy task, and I want to really thank her for doing that. I also want to kind of end with thanks to everybody who made this happen. I want to thank our donors whose generous support makes this lecture possible. It's already become a permanent fixture at the school, but we would love to do more to honor Dave's memory. And if any of you have ideas or thoughts on ways to do that and would like to support us, please reach out. We would love to hear from you. I want to thank the staff at the center and everybody at Stern who provided the support to make this happen. I would also I'd like to thank all of you who attended, and it is your participation that perhaps more than anything does justice to what Dave was all about. So I want to thank you all for being part of this. And with that, I'm going to kind of again, end by thanking John once more for a fascinating addition to the Dave Backus lecture series.
Thank you so much. It was enjoyable and the questions were great, and it was a great opportunity, and it's good to remember Dave and all he did.